It is so not fun to look at the markets right now. Hey everyone, it's John Chapman, recording a short video to go over a number of charts with you to help give some perspective on this market environment. And also to ask the question, how should we as investors be responding to this and thinking about the long term? So this chart shows us the S&P 500 along with a few other indexes, things like small cap stocks, internationals, bonds, so forth. And as you can see, since January till now, June 3rd, it's been a rough year for most major asset classes. Looking at another chart of big names in the US, companies like Apple and Amazon are both down. Tesla stock is down almost 40%. So it's leaving a number of people obviously feeling concerned. To add to that, this chart shows what the average drop has been during a bear market since 1950. And at the bottom, we can see that the average drop has been about 30%, and it's occurred over the course of about 300 days. And to recover from that drop, it's taken 600 days, over 1.5 years, to get back to even. While that can be disheartening, we don't know what this market experience is going to be like, but it does help give us perspective that investing involves risks, that a recovery can happen, but it takes time. But let's keep looking at a few other perspective charts. This one shows here that the average intra-year drop is 14%. This chart goes back over the past 40 years. And the way that I think about this in my mind is at the beach, the tide will go out and the tide will come back in, but the water doesn't go away. And in this same way, when we look at the broader market, it's common for it to drop. We don't know if it's going to drop 14% or 20% or 30%. But again, long-term investors should take heart that 32 out of the past 42 years, it's ended the year in December positively. And zooming out even more over the past 100 years, 75% of the time, if you invested money in January and you wake up in December and look at your statements, you would have grown your investments over that time. And this should be, again, encouraging to see that the long-term perspective for the U.S. markets can produce some significant compound growth. This is another way to visualize the growth in the market over the past 100 years. And I'm not saying this will be what the next 100 years look like, but just consider all of the innovation, all of the smart people that work at our major corporations, and the potential for future growth, whether in the same companies or new ones in the future. Let's get really practical, and maybe you're early in your career, maybe you're mid-career and thinking about retirement. You could even be in retirement. What this shows is the power of ongoing savings and long-term compound growth. This is a portfolio that consists of $500,000 and it's growing over 10 years. And let's just create an example scenario that it grows on average 7.2% over that time. This account would double from $500,000 to $1 million. Now, adding $1,500 per month, let's pretend that's in a 401k or in a brokerage account with stocks. That could be you and your company's match. That'd be $18,000 over the course of the year. That same $500,000 portfolio would grow to $1.26 million. Your contributions of principal would have been $180,000, and the compounding growth would have been $580,000. So to put this all together, while the market is down and you may be experiencing some fear or trepidation, this is a great time to continue saving into your 401k or brokerage account and receive the benefits of compound growth over a long period of time.